Knowing how to analyze a deal is a critical skill for passive investors, and today we're breaking down the most essential steps to help you analyze a deal. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show. I'm your host, Jim Pfeiffer.
And I'm co-host Paul Shannon. Today we're diving into the essential steps for analyzing real estate syndication deals. Our guest, Tyson Miller, is an experienced passive investor who has spent years perfecting his approach to deal analysis, helping countless investors make confident decisions.
We'll discuss how to quickly filter through pitch decks, validate underwriting assumptions, and identify the red flags that could make or break a deal.
Evaluating an investment has several steps. For the purposes of today's conversation, we're going to assume that you've already vetted the sponsor, you understand the market, the local macro factors, supply and demand. Maybe you've analyzed the private placement memorandum, the operating agreement. Today, we're talking specifically about underwriting the deal and the key assumptions behind it.
Here's our conversation with Tyson Miller. Tyson, welcome to the show.
Thanks, Jim. Happy to be here.
Excellent. So as Paul said, we're not going to worry about the sponsor. The sponsor's already been vetted. All those other things we're assuming are good to go. We're just going to dive into the deal. And the first step of that, of course, is figuring out, do I even want to open the email? I know that we all get constant emails from a bunch of operators because we're investors, right? That's what we do. So Tyson, the first question to you is how do you decide if you're even going to open that email and review the deal at all?
It starts with a relationship with the sponsor. Today I've gotten to the point where if I don't know the sponsor, it's not a know, like, and trust situation, or it's not being recommended by someone that I trust, chances are I'm not spending much time with it. I will open some of those emails just to get the macro of what the trends are. But for me to spend time diving in the deal, I got to know the sponsor.
I'm similar. And you get some of those that are like, hey, this is the last deal you'll ever need, 400% IRR. I mean, those are the easy ones to just dump in the trash, but it's the other ones of maybe from an operator you might have heard of before and you're not sure. So, the first part of it is, do I just delete it or do I open it? So once we've gotten past that, once you decide you open the email, what are you looking for in the pitch deck to quickly kind of filter through whether it's worth digging in really and getting started?
Well, I approach everything like any kind of investing is building a portfolio. So in my portfolio, I have asset classes and I have allocations for those asset classes, be it multifamily, be it debt, be it private equity, self-storage, whatever it may be. So if I'm interested in something or I get that email and I open it up and it might be multifamily, but my multifamily bucket is full, I'll look at it, but I'm probably not spending much time because I really try to stick to my rules and my allocations with my overall portfolio.
That's restraint, right? I don't even know what the patience or something, because I get kind of excited. So do you look at other things? Like, do you look at, okay, maybe you already have enough multifamily, but if maybe this deal has a certain IRR or it's in a market that you like, or you like the profit splits, could that be a factor, or is it just you strictly stick to the plan?
I try to stick to the plan, but I like the shiny objects. I will, if it's something new that I haven't seen before, then absolutely I'm going to dig in because I just want to learn the market. I want to know what's going on. I may not be interested in the deal, but it's conversation. I'll pass it off to some fellow investors, let them take a look, just get some conversations going. So yeah, absolutely. If it's something new, I'm diving into it. I will violate my rules at times, both in allocation, as well as other areas. But I tend to not go into things like I try not to get caught up in the IRR. 40% IRR. All that's underwriting. It's just speculation. I blow all that off, and I'm starting with: is it some kind of asset class that I want to invest in? Am I interested in this? And is the macro of the market fitting for this right now? And if any of those are no, then I'm moving on.
I love that approach, Tyson. I think that's really prudent. It's difficult to build a diversified portfolio when you're passive investing because of the high minimum investments, obviously. So to have that kind of criteria, I think is a really good kind of starting point if you're a passive investor to what your portfolio should like, let's say in 5 years or 10 years. And that should be diversified by sponsor, geographical market, asset class, debt maturity timeline. So you're not running into a wall of maturities in your portfolio and something goes wrong in the market and all those deals are having issues. So I think think that's a great way to look at it. Let's say you open an email and it fits the profile of what you're looking for. There's a gap in your portfolio you're looking to fill, let's say multifamily for an easy example. What do you do from that point on to kind of filter through that deal and give a quick analysis before you get into more of a deep dive?
I'm usually looking at, again, starts with sponsor. I know we're assuming that we know the sponsor, but I want to know their track record. You see it where you might have a sponsor you've worked with that has done a lot of debt deals, and this is now the first time they're introducing a multifamily deal. So that's gonna matter, and that's gonna deem how deep I dive into it. But let's assume that's all okay. It's a sponsor. It's something they do. It's in their lane. Then I will start looking at just the materials, the very high level, the materials that the sponsor's giving me in terms of the market. And I want to know their reason why they're investing in the deal. I want to figure out, why are they excited about this? Not even why I'm wanting to get excited. Why now? Why this deal? Why this market? Why now? And I want to get a clear understanding of that it's just not, we need a new deal in our pipeline, or we stumbled across this, that there's a true why, and then I'll start picking apart the deal from there.
I love that, and I haven't heard that one before. So how do you get that why? Are you expecting that to be explained in the email? Are you expecting that to be in the pitch deck, or do you call them up and say, hey, why this deal?
A little bit of both. I want to be able to infer it in the pitch deck or the email communication that's coming across. If they're not giving me that information, if they're not giving me that excitement, and it's more marketing fluff. This is the best deal. This is the last deal you ever need. This is the greatest deal on the planet. That's a turnoff for me. So I'm wanting to see, hey, I want to see it concise. I want to see the information very concise and well thought out in the email or the initial pitch deck. And then it will usually progress to a conversation with the sponsor. And I want to hear that same concise reasoning, thoroughness of the investment in that conversation.
What's the order of operations here, Tyson? You look at the actual pitch deck? Do you watch the webinar? And then do you always pick up the phone and call the sponsor?
Always pick up the phone and call the sponsor. I will never invest in a deal without a conversation with the sponsor. And depending on who the sponsor is, it could be a 15-minute conversation, or it could be an hour and a half conversation. Depending, it may be multiple calls. Some deals I might be on the fence. Some deals I might have to talk myself into doing them, and I need multiple conversations to get myself there. I think a lot of investors get excited about a deal. They see the IRR, they see the returns, they want to jump in. They have capital sitting on the sideline. They want to get it invested. I tend to look at it the other way. Is everything that I look at, I'm usually trying to talk myself out of it first. I want to find reasons why not to invest. And then if I can get through my own walls that I build there, then we can start really diving in.
I love that, because as you kind of mature in this business, so to speak, or this investment style, your inbox starts to get really full. So you have to have some sort of a filtration method, right, to get through this stuff quickly and to be able to say no quickly. And I think what you're talking about as far as the operator being excited about the deal, are they presenting a unique story, right? In today's market, anybody can really go out and acquire. That's not necessarily the difficult part. It's finding those really good deals. And a lot of times those good deals are ones that have unique stories built around them. Like it's a legacy owner that's owned the asset for 25 years and just hasn't kept up with market rents, for example. So those types of things are something that catch my attention too. And I look at the offering memorandum at this point in the process and try to see if there's anything in there that just completely turns me off, like really high fees. Is it a hold period that's unacceptable to me? I'm not really a forever hold kind of person that likes deals that just don't have a maturity, where there's no exit plan. So stuff like that is something you should look for to see if it just matches with your investment style and philosophy. And if it doesn't, you can just move on to the next. You're not going to miss a generational opportunity, quote unquote, by looking at the next deal and just passing on the one you see in front of you.
And I think what's important too is getting to that no. I have a pretty firm rule that once I say no, it's a solid no. I'm never going to go back. That email's deleted. I'm not going to revisit that opportunity.
And it's just that deal, right? That doesn't mean the next deal that comes from the sponsor, you're like, no way, right? It's just the deal.
Just the deal.
So it seems like, Paul, you were talking about not deep dive red flags. You were kind of talking about, I don't even know what the word for it would be, but kind of generic red flags. Then once you get into the deal, then there's like the metrics or the things like that are deeper red flags that you're looking for. Because I think that's the best way to analyze a deal, is to find a reason not to invest. And if you can't find that reason, then you can say, okay, maybe I will dig into it. So what are some of the deal specific red flags that Tyson, you might see that would be like, I'm out, I'm not doing that deal?
Number one is probably debt. I'm immediately looking at debt. How much leverage are we talking about here? What kind of debt? What's the maturity? Paul mentioned what's the hold period. That's important to me too. I'm very much a short-term type person. I don't like the 10-year hold, the forever holds. I'm looking at top-level areas such as that. I mentioned the sponsor experience in that particular asset class, regardless of my experience with the sponsor. I'm definitely looking at that. Other partners, is there other prefec that they're bringing to this deal? Who is that coming from? How's that structured? That's very important to me in figuring out where the risk is, right? It's all about where could things go wrong.
Now, when you're evaluating it through that process or that lens, are you asking the operator for the actual underwriting file, and are you using that to make your investment decisions?
Typically not, no. I'm asking the questions and I'm expecting honest answers.
And sometimes I will ask for the underwriting. Like there was one operator who had very skimpy pitch decks, and this was in the height of it, right? 2019, when everything was, turning in 18 months, and it was just, they didn't have very much in it. And so I asked for the full underwriting file just to see if they'd give it to me. And they did. And it was this spreadsheet that had, I love spreadsheets, but my God, it had 1,000 different sheets in it. I couldn't even understand it. I dug through it a little bit, but that was enough for me that they were willing to give it. And I'm not, I'm kind of I think you mentioned it off camera, Tyson, but sometimes you're kind of a 30,000 foot guy. And that's what I am too, where I feel like, Paul, you might dive in a little bit deeper than us because you have been an operator and you're doing a little bit more due diligence than others do, where I think once I've approved the sponsor, I'm not going to re-underwrite the deal, but each of us does that differently. So I'd love to hear from you, Paul, like how deep in do you go and what are some red flags that are, bounce you right out?
I do go pretty deep into the underwriting, and I always ask for it personally. And part of the reason is just to see if they'll give it to me, right? Like you pointed out, Jim, it's like interesting to find out why someone would want to hide something that is so fundamental to making the deal make sense on paper, so to speak, right? What is there that they're not telling me? And to me, that's an immediate red flag that says, no, I can't invest with this person. A lot of people will say, well, it's proprietary. It's a model that we developed. Okay, well, there are ways to send that out where, I can't corrupt the cells. I can't forward it on to other people, et cetera. But I want to actually see what inputs were used to derive at the outputs that are on the offering memorandum. The flashy metrics like IRR, equity multiple, cash on cash, those are nice, but they're only as good as the inputs that are used. So when I see inputs like, let's take rent growth, for example, we've had, some ups and downs in rent growth where now it's flat to negative, but a couple of years ago, you're seeing in certain markets 20% plus rent growth. So are operators still aggressively assuming rent growth will continue on into the future, given where we're at today in the market cycle and the economy? Maybe it's justified, but I'm actually going as far on occasion, if I don't know the market very well, as to call local people in that market, brokers. There's been times where when I was actually an operator and acquiring a deal actively, I went into the market and I went to other properties that were competition to this specific property and went into their leasing office and pretended that I was a prospective tenant, basically. I wanted to see their quality of product. I wanted to see what they were asking for rent, how much vacancy they had. I was asking questions probably most tenants wouldn't ask, but at the same time, I'm getting a pretty good baseline for what my product is and where it might fit in on the overall landscape of the market itself. So that's validating the inputs at a pretty micro level. But if I'm going to allocate a significant chunk of money with an operator that I don't have a track record with or a history with, that's the level I would get down to. You could really get into the weeds and ask some very detailed questions to do some due diligence, but you can learn a lot by being that prospective tenant per se, but also, calling brokers too in the market and saying, hey, I'm interested in acquiring multifamily in Atlanta. Can you tell me the market dynamics, the demographics? What are properties trading at today? What's the cap rate, et cetera, et cetera? What's the average price per door for a C-class apartment? And you can kind of marry that up to what the operator's telling you and see if their story matches up.
I think what that does is it really illustrates the different ways different people do these things, right? Because Paul used to be an operator, so he's going to dig in and really, call people and call the competition, all that kind of stuff. Where for me, and I think, Tyson, I'm not going to speak for you, but I'm not going to do that because my approach is I'm going to find an operator that I know, like, and trust. I'm going to develop a relationship with them and say, okay, I'm going to trust what they're giving me, trust but verify, right? So I'm not going to do all of that. But what I do is I'll take the financials, the pro forma, and I'll throw it into a Passive Pockets has a deal analyzer. It's basically a spreadsheet, and I'll put all the metrics in there, and it pops out and it turns things red or green, whether it fits basic, normal, quote unquote, parameters. And so I'll see what that spits out and ask questions from there. And another thing that I'll do is there's three metrics that I like to look at, and you mentioned one. on rent growth, Paul. I'm not necessarily going to call up the property across the street and see what their rents are, but I'm going to check to make sure that first year rents don't have a huge increase, right? Because this isn't self-storage where you can push a button and increase everybody's rent all at the same time. Right? If you're doing a 5% rent increase in year one, you're not going to get all of them at 5% in year one. So I want to check that for reasonability. I want to do, economic vacancy is another one. A lot of people just plug it in at 5%. Well, that's what vacancy should be, but economic vacancy is a different thing. So I want to see a bigger number or a reason why. And another metric I check is the taxes. Most counties, I think in the United States, when you sell a property or buy a property, the taxes then go up because presumably you bought the property for more. So if they have the pro forma taxes that are the same through all the years, I'm looking for an increase. So those are some of the things I'm looking at. So just open question to Tyson, Paul. I know I rambled on for a while, but do you have any specific metrics like that are kind of things that you just kind of jump in and like, okay, that checks out, I can move on to the next phase of my analysis?
Not specific, because you go way deeper than I do. Most of the time I'm trusting the operator in those numbers. I've found that with my personality, my investing personality, if I can nerd out on spreadsheets as well, and I will get into analysis paralysis when I get too deep. So to answer your question, Jim, what I tend to look for is not anything specific. I'm just looking for anomalies, right? I know the macros of the market. I keep up with that. I generally know what rent growth should be, what we should be projecting. I'm looking at all the line items in the pro forma and just looking for anomalies. Like your tax example, I may see that, but I'm not necessarily looking for that. I'm just looking for something that's very different. Why is this line item particularly different? Why are, concessions very different than what I feel like they should be? And then that goes on my questions list for the operator.
I love that because that's similar to me. I'm looking for anomalies. I just have found from putting so many deals through that deal analyzer, the three that really hit for me most of the time where I found people kind of fudging things, or not fudging, maybe that's the wrong word, but where their pro forma doesn't quite stack up in my mind are those three metrics. So Paul, do you have anything to add there? Because I know you dive a little bit deeper than Tyson and I do, but are there ever any specific metrics for you?
I just want to touch on a point that Tyson made too about validating some of these metrics. And another question that I ask often is, do you have third-party validation from outside experts on things like tax adjustment and reassessment? Because if they're just flying by the seat of their pants and saying, hey, taxes are going to go up and it's going to be this amount in year 3, that may come to fruition. But what's the justification? If you've actually got a third-party quote or a third-party insurance quote, for example, that's hard data that you can kind of rely on moving forward. So I like that. As far as return metrics go, besides the big 3, obviously, which tend to be over-publicized quite a bit, I really look at yield on cost. So yield on cost is basically the future net operating income or the stabilized net operating income divided by the total project cost. The total project cost includes the purchase price of the property, any CapEx that's going to be injected to get it to that stabilized point in time. And I want to look at it on an untrended point of view. So I don't want to assume rent growth. I want to assume that if it were stabilized today at today's rents, how would it look? And what I'm really looking for is a development spread, right? So understanding where stabilized property is trading in the market first and what that cap rate is. Let's say it's a 6 cap. If I'm buying, or the sponsor's buying the property at, let's say, a 5 cap, that sounds like they're overpaying, right? But what they're really doing is they're paying for the opportunity to buy a growing income stream. So if they can inject capital into the deal, raise rents subsequently, create some operational efficiencies, and then that yield on cost number subsequently is, let's say, a 7 or a 7.5. Well, what they've just done is provided insurance on your principal as a limited partner. So that 7.5 is above the market cap rate of 6 in that example. That means that the operator could go out and sell that property at a 6 cap, and they're basically locking in profits in that scenario. And also the cap rate could expand up to a 7 or a 7.5 before principal would start to erode. So I really want to know yield on cost. And what I found over the last few years looking at a lot of deals, especially those in 2022 and 23, was that operators were buying these deals at what they would call a discount or a great basis, but then they were getting a yield on cost after they did their construction or their turnaround or their value add plan, and their yield on cost was 6, and the market cap rate was 6. So it's like they're going to take 18 months and do all this hard work to basically get a property at market rate and not create any value. And that is not insurance on principal and expanding cap rate market. So that was all over the place. A lot of people just buy. and there's no real value creation. So I think yield on cost is an extremely important metric. And I've actually talked to operators before that didn't even know what it was. And these are experienced people with thousands of multifamily units, for example. It's like, okay, there's a red flag. So just even asking the question and seeing how an operator describes certain financial ratios is interesting. But at the end of the day, like I kind of want to look at a model and see where it breaks down. So that's why I like to get the underwriting model too, is like I'm going to put in some extreme scenarios into the cells, like an expanding cap rate of 300 basis points, or, interest rates go up at a refinance by, 300 basis points. What does that do to the deal? And how does that impact investors? Is there going to be a loss of capital in that situation? And then kind of like back down from there and say, what's the likelihood of that happening? Not necessarily that high, but where do I feel comfortable as far as baking in some really kind of downside scenarios that aren't pretty and still feeling good about the investment and the likelihood of a good outcome.
And Paul, you're going to make me never want to invest in a deal again because you go so far deeper into the weeds than I do. But, you mentioned cap rate. So I guess, Tyson, what do you think about cap rates, and or how do you look at cap rates? How do you look at cap rates? I personally look at the entrance cap rate and the exit cap rate and hope, make sure that there's a difference there. But how do you look at those?
I do. And certainly I look at the delta between the cap rates, but it's all, that's just projection, right? We don't know what's going to happen. So that exit cap rate that they're stating in the pro forma really means nothing to me. I have to apply my beliefs in the market and what's going to happen with interest rates, with everything else that's moving around that's going to impact those cap rates and the price of this on exit. I have to apply my beliefs, not what they're telling me, not their reasons for investing. I have to believe it.
And Paul, you've talked about the yield on cost, but can you talk a little bit about why it's important, or is it important to have at least the pro forma show an exit cap rate higher than the entrance cap rate, and what that shows?
I think it is really important to show a higher cap rate on the pro forma just as a measure of conservatism and being sort of prudent as to knowing that the market doesn't always participate favorably with the deal underwriting and having some downside protection baked in. So it is important because we don't know what was going to happen, as Tyson alluded to. I'm seeing some lately that are underwriting an exit cap rate that's actually lower than the market cap rate today, because these particular operators are assuming that we're at peak rates today and that rates directly correlate to cap rates and that they're going to fall. But if you think about that logic, that just makes the pro forma look a lot more strong than it actually is. So I'm looking for a weaker assumption base that actually ends up panning out much better. So let's paint a downside picture and then a probable picture and then maybe an upside rosy picture, but don't put the upside rosy picture front and center on the offering memorandum and all throughout the underwriting. I actually want the more conservative approach and giving that exit cap rate a little bit of expansion and room to expand so we can see what it looks like if things don't go as rosy as we'd like.
And I think that goes beyond cap rates as well, right? That's any of those metrics, be it rent growth, be it insurance cost, whatever it may be. I want to see that conservatively underwritten.
And for so long, one of at least the easy, like no go things was in a market that was just roaring, right? Is the exit cap rate in the pro forma higher than the going in cap rate? And Paul, now you're saying that you're seeing operators where it's reversed because now presumably we've hit the high in the market. Now we're in the bottom of the market. So now people are saying, well, the exit cap rate could be lower than the entrance cap rate. Is that a no-go for you guys? If you see that, are you like, I'm going to move on?
It's a hell no for me.
Yeah, it's a showstopper for sure.
Okay, and that's perfect, right? That's one of the things where then you can look at a deal. It makes your job so much easier. And Tyson, you said it best when we started. Like if you could find that one thing that's a no, and you're as strong as Tyson, where once you say no means no, you're not going back, then that kills it, right? One thing we haven't talked about yet, or I think, Tyson, you briefly mentioned it, debt, and you called it preferred equity. How do you guys look at debt and the equity or preferred equity the sponsor is using, and how should that be considered when you're investing as an LP in the common equity position? That's
a moving thing in terms of what the environment is giving you. And everyone along the way, I think going up through those deals that were happening in 21, 22 that are now underwater, struggling, the biggest thing with those was they did, short-term bridge debt. And so everyone wrote that off immediately that, well, I'm never looking at a deal with bridge debt or short-term debt again. And all of a sudden we find ourselves in a different interest rate regime here, and it changes things. That's not necessarily a deal breaker for me anymore because it's different now than it was then. Again, I don't have a crystal ball, but I just try to apply it to what's going on in the market. What do I believe interest rates are going to do? Is this a play that I want to make? If they have short-term debt and I believe that that's an okay play, it's not an immediate deal breaker for me. We talked about pref equity. Pref equity is also not a deal breaker for me. A lot of people shy away from that. Sometimes I look at that as a strengthening the deal because they may be bringing in a partner with more knowledge as pref eg. They may be, you can also look at it as soft or squishy payments. So, some of those things can actually help the deal depending on where it's coming from. So you just kind of have to understand all the dynamics of the debt, the current market that we're in, and where you believe it's going, and understand the bet you're making.
Well said, Tyson. I think that's great. I think it's prudent to evaluate the lender terms and the pref equity terms, considering that they're the largest capital player in the deal, sometimes up to 80% or even more occasionally if it's loan to cost bridge debt. You can rest your head at night a little bit more confidently with fixed rate debt, but I agree. It's not to say that you shouldn't consider any deals with bridge. If you look back at 2022 when the federal funds rate was at 0 and interest rates were sub 3 and cap rates were super compressed, interest rates and cap rates are correlated, not one-to-one necessarily, but interest rates certainly heavily impact cap rates. So at that point in time, you figure if we hit a stride here where interest rates start to go up, that could impact bridge debt. And with where these deals are getting acquired with such low margin of safety at such high bases, that's going to put a lot of strain on the NOI and the cash flow of the property. Whereas today, going back to what I was saying about cap rates potentially compressing, that is a bet you can make. And with bridge, you see that the federal funds rate is coming down now. Bridge is based off of SOFR plus a spread, so that rate will come down. And historically, over time, using floating rate debt has resulted in more cases than not in a favorable outcome. It's just that when you get caught pretty hard. So you want to make sure that the macroeconomic, situation is sort of going to likely play out in your favor if you're going to take those kind of risks. And I think it also goes back to our conversation on diversification, right? It's okay to take bigger swings and swing for the fences on certain parts of your portfolio. On the whole, though, you want to probably be conservative and not risk too much on one specific asset or one specific operator or one specific debt instrument used across all of your portfolio. So it really comes down to risk tolerance too, and what you're comfortable with.
And I think mentioning diversification there is key for the debt picture because, if you had not looked at diversifying debt in, as Tyson said, 2021, 2022, and all of your multifamily properties were on bridge debt, you ended up being in a lot bigger trouble than if you had said, okay, I have a bunch of bridge debt, let's balance that off with some other maybe safer types of debt.
Or even if you want to be in the same asset class, maybe you sit in a different class. Maybe you go to A class, maybe you're pref ec in multifamily, and that's another way to diversify using the same vehicle.
Yeah, that's a great point. And since we're talking about debt, right, that's one thing that caused a lot of the issues that we're seeing now. But it wasn't just the debt that caused the problems. There was also the increased cost of some of the inputs, materials that the operators were using. So inflation had an impact, as did the increase in insurance costs. So as you're looking at a deal and doing your deal analysis today, do you factor that in, or do you look at the pro forma and see, hey, where are those costs going in? Because those are big costs that if it's a heavy value add, the cost of materials is important. And every deal, the cost of insurance is important. So how do you include those in your analysis?
I do look at those, but the same thing, I want to see them conservative. I want to see them going up, right? I don't want to see them making a bet that insurance costs are going to go down or that material cost or labor or whatever else is going to significantly drop off just to boost the pro forma. That's an immediate red flag. That's a no for me. So I don't pretend that I'm smart enough to understand what insurance is going to cost a year from now, but I certainly want to see it higher than it is the last T12.
Yeah, to kind of couple with that question, Tyson, we obviously have a new administration coming in right now, and there's talks of tariffs and potentially inflation having another takeoff or a run here. Is that factoring in at all into your decision-making process around investing?
Yes and no. I've said a couple of times I try to look at the macro theme, but I'm smart enough to know I don't know. I'll leave it at that. I'm not going to get into a deal just because I believe inflation's going to kick in, or I'm not going to say no just because I do or don't believe that we're in that environment, because we've learned that can turn rather quickly.
And I think it comes back to me, at least, for diversification, right? And also allocation of capital. I try to, dollar cost average, meaning I want to try to invest in a deal, not every month or whatever, but just periodically make sure I'm continued to invest no matter where the market is, because I can't predict, I can't time the market, I can't do any of that. So I'm constantly thinking, okay, if a deal comes around and it fits all the parameters that I need, I like the deal, I like the operator, then I'm going to invest in it. I'm not going to say, well, I'm going to hold off, because I want to buy at the top of the market, the bottom of the market, and throughout, so that I'm protecting myself by dollar cost averaging and diversifying.
I'm a big believer in that. I'm a big believer in probability and getting enough occurrences in with your investment. So if you invest in this long enough, or enough of these, some of them are going to go south. It's just probability. So you need to, if you're only invested in 2 deals and both of them go bad, it's not going to be great for you. So you got to keep turning capital. And that's why, some of these tribes and group investing is great these days, because it allows you to invest at lower minimums and spread that out over more investments.
Yeah, absolutely. And it allowed us to test some investments, and some worked out and some didn't, because Tyson and I are in a tribe together where we did some new things, new interesting things, and some are great and some are just a lot of emails about people upset, which is interesting, I guess I will say.
It's entertainment.
It is. It's a weird type of entertainment, that's for sure. That's a whole other podcast, Tyson. We'll get you back on for that. I do have one final question for me is, so you look at the pitch deck, it comes in and you do your analysis, you watch the webinar, and then you said you talk to the operator once at least, and maybe more. What is that conversation like? Where do you get the questions to ask? And because, as I'm looking at it, I could call up and ask questions, but I'm just going to get the marketing pitch. So how do you get them to tell you more than that? Do you come up with a list of questions, or do you just have a conversation, say, explain the deal to me? How do you address that?
That's funny you say that. I actually kind of want the marketing pitch. I want to start there, because I want to hear them try to sell me on why this deal, why now. But I go into that not rosy-eyed, knowing that it's a marketing pitch. And then from there, I'm going to start asking questions and turn it more into a conversation as we get into it. But what I'm hoping to do is to get them to expand upon their reasoning beyond what I can extract out of the pitch deck.
How do you have multiple conversations about a deal with an operator unless you're asking very specific questions? Because the way I do it is sometimes I get those, I put it through the deal analyzer, as I said, and I get some red flags and I ask those questions. And then I find myself like, I'm not Paul, where I'm 6 levels down into their Excel spreadsheet, right? How do I generate questions?
What I've found is every answer to a lot of answers to a question tends to lead to another question. So it's just organic. And I think if you do this enough, you get good at those conversations. You start having, red flags or other questions, or get them to explain. Sometimes I'll ask an operator to explain something to me that I already understand. It could be something basic or something detailed, but I want to hear their definition of it. I want to make sure they can articulate it correctly to build confidence in what they're planning and what they're investing in.
Yeah, that makes complete sense to me.
I love it. I was once told that if someone can't explain to you what they want, the timeline they want it in, and exactly the ask from you in 90 seconds or less, then they don't deserve your money.
Yep. If you can't explain it to a 5-year-old.
Well, I don't have a 5-year-old anymore, but I'll try and explain it to a 17-year-old, and he won't be listening, so that won't help at all.
So you gotta text them for that.
Exactly. There you go. All right. Well, Tyson, this has been fantastic. Thank you so much for being on this show. You've given our listeners a ton of great information. So thank you, and we'll definitely have you on again to talk about some other stuff.
Thanks, Tyson.
Appreciate it. Enjoyed it.
Thank you to Tyson Miller for joining us today and sharing his expertise on analyzing syndication deals. From filtering pitch decks to validating underwriting and identifying red flags, making smart investment decisions starts with understanding how to evaluate the deal. By following a structured framework, you can confidently assess opportunities and protect your capital.
If you enjoyed this episode, don't forget to like, subscribe, and leave a comment on your deal analysis tips or questions. For more tools and resources on passive investing, visit PassivePockets.com and join our community of like-minded investors with a 7-day free trial. And don't forget to take our survey at the link in the description or at PassivePockets.com/survey. Thanks for tuning in, and as always, happy investing.